Hey, this is Sasha Evdokov, and welcome to another episode of Let's Talk Stocks, episode number 85, Why Stocks Snap Back, a little bit on retracements and Bollinger Bands basics. So in this lesson, what we'll really focus on is more so why stocks snap back, and then of course, more on Bollinger Bands, a little bit on the basics of it. We'll talk a little bit on retracements because it kind of fits together, but we've talked about retracements and Fibonacci sequences in other modules. So in here, what I'd like to do is concentrate a little more on Bollinger Bands, the basics behind them. But again, we're only covering the basics. I probably need to do a more in-depth, full lesson on just Bollinger Bands. However, I think that it's more important that you still concentrate and focus on price, action, behavior, the volume of the stock, and the overall bigger picture, because that in the end matters much more. The Bollinger Bands are still lagging indicators, and it's just an indicator that you can glance over. All those other indicators that are fancy and popular, they're mostly lagging indicators, and they're driven from the price spread, the range of that price where it opens and closes, and it comes together and uses also volume and the basics behind that stock, and it creates a little bit of an indicator for you. So in essence, if you know how to read price, the way the prices move, the range of those bars, along with volume, you have all the indicators that you need. You really do. So we'll just cover a little bit of these Bollinger Bands and just give you some basics, and then maybe in the future I'll do a more in-depth analysis of Bollinger Bands. So before we get there, I do want to share with you that the website here does have now more mobile and responsive navigation. So for those of you that are using this on iPads and so forth, if you go ahead and now you can see a mobile menu that works a little bit better. Typically, the websites and the things that we get into, the websites fixing things here and there, we try our best, but my main focus is usually to produce more educational content than have a fancier website. So in either case, now this works pretty well, and you can go ahead and use that on your devices, your other smaller devices, and it shouldn't have a problem. And in this example, what I'd like to do is really concentrate on Tesla here, just to illustrate the example of the retracements. I think it's an easy example to go through, and I'll do that after I show you really what we were going on and talking about here with one of the people here on social media. So when you look at social media here, you can see that somebody asked me about the Tesla stock, and this was, again, a public conversation on Twitter. So when they asked me about Tesla, I mentioned that you have some support here at the 205 level. The 200 and the 190 are levels to watch as well. And this was 14 days ago. So if we backtrack this, and you can see that Michael Perry here, looks like you were right on this one, up $6 at 2011 right there. So if we backtrack this 14 days and we take it back 14 days right around there, this is when this big spike was coming down on Tesla. So why is it, or how did I come up with the figure? How did I read this chart, and how does it make sense to choose these figures? Well, before even knowing the figure, you have to understand how stocks move. So why do they snap back? Well, they snap back because people buy their shares back. So if you're doing a long position, let's just say you're going to the long side right here, you're going to have little pullbacks, and you may get a little power higher, and then you'll have a little pullback. So why do you get these pullbacks? You get these pullbacks because people take profits. They take their money off the table because they get a little too excited. The risk becomes more in the other direction, so you take some profits. Or you also have shorts now stepping in. When you have short people stepping in, selling the stock first, buying it back later, that also triggers more sell orders. Now, this happens here when you look at the S&P 500. This happens the same thing on the way up. So when we have, let's just say from January, February, these lows, these stocks pop over here, and then they go ahead and pull back a little bit. They pop a little higher, they pull back. So basically, it's a rubber band effect. And if you look at it overall, and you look at it on a moving average, which is this moving average here that we have, you can see that the moving average averages things together. And if I really just hide this, let me just go ahead and hide that. You can see that now you can still get a rough moving average without that indicator. Now, I put it there for a guideline. I use the 20-day. Why do I use the 20-day? Again, I emphasize because it's 20 trading days in a month. Okay. Now, if you get rid of that indicator, I bet you could kind of guess where that average or moving average is going to go. So if you learn to read the prices, you can still do this in your head. You don't need this indicator. You don't need to clutter your screen. But if you put it there, it gives you a more precise average. Okay. So here, if you look at this, you can see that once we get stretched too far in one direction, stocks come back to that average. So they snap back. So if we, let's say we get too far extended over here in November beyond the average speed, we're overextended. Then we snap back in the other direction. And if we snap back too far in the short side or in the bearish side, we snap back the other way. So you're basically doing this rubber band effect. I've talked about this rubber band effect that happens, that you get this snapping action. If you get a major snap down like we had here in January, you're going to have an even wilder snap back higher. So you had this little January pop, but really the main pop that you had, if you look at it on a bigger picture, the main pop that you had, here's the weekly chart. Basically, what happens here on this chart is you had this moving average that was kind of going, but then you had a major snap down in January, and then you had that major snap back up again in February, March, and now you're going to get it a little bit snap back down to that level again to kind of get closer to that moving average. Now, those of you that have watched episode 83, 82, when I was at those doctor offices, I did day trading things. I talked about that I was more short and going into short areas, meaning trading more short. And there was a reason for that. So review those videos if you haven't yet, or if you haven't watched those. But you get to see how these things roll over, and I really break it down in detail there. But understand that basically stocks, once they get too far extended, they'll snap back and go the other way because people take profits, because it's just normal and healthy. They just can't continue to go straight up. It's not healthy, not normal. And as I've mentioned before in the past, a more healthy approach would be something like along this angle. This is a little bit of a slower approach. If you have like a 20-degree angle upward is a slower approach. 40-degree, 30, 40 degrees may be more healthy. If you get a little bit of a steep incline in stocks, something like a 60, 70, 80-degree approach, you're looking for a quicker pullback. And the faster they go up, the harder they come back down because there's more people on that side of the trade. So that's one thing you need to prepare. Now, we've talked in the past, how far can a stock retrace or how far can it pull back? Just to give you some quick insight, basic pullback, basic retracement, a stock can retrace based on the swing points. If we look at Tesla from February all the way up until April, a basic pullback is 50%. That is a healthy percentage, and that means nothing is wrong with the stock. Can it go a little bit further? Absolutely. Can it go a little bit less? Absolutely. But if you take your Fib sequence or Fibonacci, which we've talked about in the past, and you draw this line right here, which is the number that I came up with, and really there's a calculation to do this. You take the lows of here and the highs up here, and if you can take a look at it in the green course, Stock Trading Foundation, which will give you the precise levels of these Fibonacci sequences. And this is what I do on a calculator level. This is just a quick guess, and these things help you draw them out. But if you want the precise figure, you do this on a calculator, or you do this in your head. typically taking 61.8% of something is not as precise. For me, I just have a quick calculator that I do it on. But for you, if you can do it all in your head, by all means, go ahead and do that. So here, when you take this retracement, this gives you a rough guideline right here with these Fibonacci tool, and you can draw it out. And this is how I came up with that number. A basic healthy retracement to that 50% level would be right around that 205. And this is exactly what I mentioned right here. It was some support at the 205 level. You even have some at 200, and the 190 levels are the ones to watch. So that's how I came up with this number. Now, this stock, you're also paying attention to how far is it coming in? How fast is it coming in to these levels? Because we know stocks are like rubber bands. I'm watching these highs, came into these levels, rejected it, so it's going to be a rubber band. We also know that it's further away from this moving average, so we know it's going to snap back. And how much is it going to snap back? How far accelerated? Is it accelerated at like an 80-degree angle, a 40-degree angle, maybe a 30-degree angle? How far is it accelerated? So that's how it tells me is if that snapback is only going to be light and minor. Maybe it'll be light like at the 38% level or so. Or is it going to be like a 50% level? So in this case, because it was a little accelerated, tells me 50% rather than that 38.2% level, because it already was breaking that anyway. And in fact, it could have gotten to that 190 level of 61.8%. And, if you take a look at this, you can also see it hitting some predominant swing points over here in January of 2015. So that's also something to consider. Now, again, remember, these are just basic tools and guidelines. You do your analysis, you put it together, and you start evaluating what is your risk to reward. Where are the probabilities that are in your favor? This is what I do. This is what I do, and I look at where is the volume? How is the energy of that stock going? How far extended is it? And it's all about putting those puzzle pieces together. It's not about one indicator, one thing that's going to tell me the magic bullet or recipe like a stochastics, RSI, MACD, all that stuff. No, because they all work off of volume, price spread, price action. They all work off of that. That's what they work off of. So if you get this, what I just explained, you're going to get everything else. You got everything else if you can get this. Okay, you don't need to make your life more complicated. If you got this as a foundational level, then I start to maybe look at things at a maybe Bollinger Band, maybe one or two other indicators that I might go in detail about in the future. But right now, I don't want to confuse you. So here, I'm just going to touch base a little bit on Bollinger Bands here for you. So with Bollinger Bands, it basically takes a statistical evaluation, and you can see how it relates to moving averages as well. So what it does is it tries to contain the probabilities that your stock, 90, depending on the range that you set up, but let's just say 98% of that stock is going to be contained in these range or these bands, and you can set them up. Again, you have two standard deviations. If you don't know statistics, you might want to do a quick little review about standard deviations, but I'll try and touch base on it here in a second. You have a period, again, 20 days, 20 trading days. And then, I do my standard deviation. I keep it on a simple moving average. You could do exponential, but I keep it simple. But basically, if you look at standard deviations, I keep it at 2 standard deviations here on this Bollinger Band. Now, if you don't know what standard deviation is, here's a quick little image, and you can just look up standard deviations on Google Images or something like that and read a little more about it. Again, this is something I'd have to go in a full 40, 50-minute lesson about to get it, really tackle it. But again, this is just a little taste of what it's about. So again, this is not very in-depth or in as much detail as I'd like to go into it, but it'll give you a rough idea. So here, basically, you can see here I have a 2 standard deviation model right here, and then you have 3 standard deviations. So basically, this is a bell curve. And the percentage or the likelihood of something working out is within this range. And you have these endpoints and the endpoints over here on the left and right, where if you think about the stock going up or down, it's going to fall somewhere in here. Now, this is statistics really, the statistical deviation that the price is going to contain in this area. So meaning, simple terms, what is the probability or what is the chance of that stock being in that range? Okay, one standard deviation is going to put it at 68.3%. If I do two standard deviation, it's a 95.5% chance. And if I do three, it's a 99.7% chance that the data is going to be contained. So again, look up standard deviation on Google Images or something. It'll give you a rough idea of how these things work and read about it. Again, this is something that we could go in much more detail about, but it gives you a rough idea. So anyways, here we have a 20-day period. Again, that's our moving average, and two standard deviations. So again, we are trying to contain 95%, roughly 95% of the price levels in that range. But again, this is a rough guideline. Again, this is complementary to all the other things. This isn't something where I make my trade decisions based off of that. So let me be clear again. Big warning here. I don't make trade decisions based on my Bollinger Bands, because stocks can go much higher or much lower beyond Bollinger Bands, and they can totally switch around. So that's one thing that you want to be very cautious about. So, for example, if you're starting to change this to, let's say, 3 standard deviations, that means 98% of the data is going to be contained in there. Now, you can see certain times it doesn't happen, and that usually happens due to earnings and some other factors like we had in August-September time in 2015. So when we look at 2 standard deviations, we got 95% of the data. And here you can see a few outliers. That means when you get a few outliers, chances are it's going to snap back. It's a little extended, but it's not always the case. You also have to pay close attention to the volume, the energy that the stock is doing, and the price. Because, for example, here that we've had on Thursday, May 5th, 2016, you had a break of that Bollinger Band dramatically, and it still continued lower for a few days, and then the stock continued to pop a little bit. And that is simply because of other factors. Again, this is just a guideline of containment, okay? And again, with Bollinger Bands, they're basically related to, let's just say, this moving average. It just makes things easier, because if you see this moving average, you can basically draw out the Bollinger Bands. The wider, the more volatile the price risk or the prices. So you can see as you get more volatile, as the price spread becomes bigger, these Bollinger Bands expand. So when we have sell-offs, typically they'll widen because you have wilder snapbacks. And as they let's just look at the SPY here. As prices don't move around much, they get a little more contained. They get a little tighter. Okay, so that's what happens. And as you start this massive sell-off, you'll probably get wider bands, and that is simply to contain the prices. So even without these Bollinger Bands, you can go ahead and really kind of draw those out yourself. So, for example, if I was just to draw the Bollinger Bands out, I could probably just do it with the moving average. Again, I'd be containing my prices, and you can kind of draw out your Bollinger Bands. You don't really need to have Bollinger Bands to really understand where prices are overextended on your stock. Simply just having a moving average or just looking at the price, the volume, the behavior gets you insights to how far extended they are. But this is what these types of indicators do, is they give you insight, but people use them without really understanding the whole core, the foundation behind it. They use them and they make trade decisions off of it. So when we look at a stock like a Tesla, we start looking at it, you can see that over here, this Bollinger Band, again, would tell you that we're too far extended. And then you would think, okay, we're going to snap back. But that's the problem, is people make their decisions solely or only based on this one indicator, and they don't take into account the other factors and the other things that are even the core of the chart, that are the most fundamental things of the stock, which is the price, the energy, and how it's moving, acting, behaving, the volume. Okay, so they don't take into account the energy, the flow of momentum and energy in that stock. So here you can see we hit that Bollinger Band. We're on the outer skirt of it, and you would think, okay, we're going to snap back, but we don't, and we continue moving lower. So here for me, what I do, the way I look at this is, are we a little extended? If the answer is yes, then you would say we should have a little consolidation or snap back soon, or we could get a little major drop in prices, which is what's going to happen, which is what really happened. You can see that these Bollinger Bands are not always going to work out. So look at it over here. If you look at the S&P in August of 2015, how we just, boom, the Bollinger Bands widened out dramatically, and we were way down an extra, let's see, 14, 15 points on the S&P. We just snapped down and took those stocks right out. And that can happen, especially with a more volatile stock like a Tesla. And that's why, if you know and understand the core of, how far things are extended, where they're coming into, how fast they're coming into, it's more important. But when you start getting into Bollinger Bands, it gives you just another guideline. Again, retracements, we've discussed in the past, review that. But retracements give you some basic key levels to watch of where the potential support, resistance levels could be, how far that pullback could be. Again, and even looking here, you're watching at how far that snapback could be as well. So you're looking at different things. Actually, it would be the other way around. So you're watching those different things at how far snapbacks could be, and so forth. And that's what you're looking at. But really, you're taking into account multiple things, and then you're just glancing over these other little subtle things from time to time. That's how you add in indicators. Okay, you don't make decisions solely on these MACD, stochastics, RSIs, or Bollinger Bands. You're glancing over them to confirm your analysis, because really, if I took all this off, even the moving average, the only thing I need to trade is price and volume. What more do you need? You don't need anything else, because you can drive everything else from that. You can drive the moving average from that. You can do it manually. These things help you, like a moving average like this will help you to see that moving average. Bollinger Band will help you to give you a rough guideline. There's a formula that's done, and you can look that up. It gives you a guideline of where things are overextended, either to the upside or to the downside. So if you're coming into these highs, you can see that right here, we're coming into these highs. You would think at this level, you would say, okay, we're ready for a pullback. And you do get a little pullback. It comes back to the average, but that doesn't mean stocks can't go much higher, because you have this resistance level up there. So that's why you can't put as much emphasis on these things. You got to look at the bigger picture. And that's really what I wanted to share with you, is that, stocks, they snap back, they pop back, they retrace, and you're using the core, the fundamentals to make your trading decisions. And then all these other indicators that you're using are just another guide. It's another tool to give you a quick validation to your analysis and to see that things are moving in the kind of the appropriate direction. But you shouldn't be emphasizing all your decision making for trading stocks based on one single indicator like these fancy indicators. These are lagging indicators. Really, you need to be making your decisions based on this and the core fundamental analysis that you do. The fundamental analysis meaning the foundational analysis between price, action, the price spread, the range, meaning the open and the close price, That's the range. That's the price spread. That's what you're doing your analysis on, and volume, and how that ties in together. And then you tie that into glancing over, let's say, a Bollinger Band or a Williams advancing declining, all these different things, MACD stochastics. Then you glance at them. You pick one that works for you. You don't have to use Bollinger Bands. You could use MACD stochastics, this and that. I'm just using Bollinger Bands right now as an example to give you some insight, because it's an easy one to explain and for people to understand that it's a little too far extended, or it's a little too far oversold, either overbought or oversold. So you come back to this moving average. But you can choose either RSI, you can choose MACD, stochastics, you can choose one that works for you, that you like, that you can relate to. But again, you're just glancing over those things rather than making full trading decisions off of them. Okay, so I hope that was a little bit helpful. I think I'm going to go ahead and put it in my notes to do a very in-depth or a more in-depth lesson on Bollinger Bands that we can do sometime in the future, maybe in the next month or so. And that way you can get some real in-depth of analysis on how to use them, how to properly use them, and really get some insight, maybe along with some other indicators in the future as well. I don't like to overemphasize these things, because the problem is I find too many people get stuck on these indicators so much that it really hurts their trading. They put too much emphasis on them and it burns them. It actually kills their account. They trade because they're lagging indicators. Remember, these Bollinger Bands are behind the real price action. They're behind the real-time trades, because they average the prices together, right? Just like the moving average, it's a little behind the current price. So that's why you got to learn the other core items first, and then you can tie this in. So don't try to jump into all these fancy indicators. If you're the one trading, if you just started trading 3 to 6 months ago and you're already using Bollinger Bands, MACD, stochastics, and they're all in your graph, clear it all out. Really, this is all you need is volume, all you need is price, and learn to read the charts correctly in a simple fashion. I know it may sound weird, but I did the exact same thing in the past, where I had so many things on screen. It confused me. I didn't know what I was trading off of. This is really what you want to watch. Simple. Keep it simple. Keep it simple to the point where you got it and you understand it, because all those things come from this. They come from that price. They come from the price spread, the behavior of the stock, and really the volume. So learn to read that, and it'll turn your trading around 180 degrees. If you're negative, if you've been losing money, it's going to turn it around to, once you understand it, you'll be profitable completely around. And really, that's what it does when you really understand something. That's what it does to your trading. All right, so I hope this was a little bit helpful. You get it, you understand it, a little more about these indicators, how they work, how they operate. Again, we'll talk more about Bollinger Bands in another lesson, and we'll just really concentrate on them along with maybe another indicator or something like that. As far as the 20 Rules for Investing Success book, I do have it ready. I mean, it is finished. I'm just waiting for Ryan here to wrap it up for you. It's going to be for free on Kindle here, so he's just converting that book. So probably next week we'll get it out, and we'll also it'll be free on Kindle for I think they do like a 3 or 4 day promotion there. So we'll do that promotion, and then after that it'll be free on PDF. So you don't have to worry about it if you miss it. But if you want to get it on Kindle, it'll be available that first week probably on Kindle first, and then the week after or so on PDF. So we just need to wrap it up in the sense of uploading it to the Kindle format in their file format system that they want. And once it's up, I'll let you know, and you can go ahead and just download that book. Again, simple, short little book, absolutely free, won't cost you anything, and just for being a part of the newsletter. Also, as far as these video lessons go, we'll probably start doing these more in a webinar setting here in a couple of months. I've changed the website there around, and we'll be doing more webinar based in a way for us to interact together, whether that's a 10-person room, so that way you feel a little more safe and comfortable. That way it doesn't feel overwhelming with 1,000 people, but there'll be recorded webinars. So that way if you have questions, you can ask specifically. We can evaluate and look at the stocks that you're looking at and really hone in lessons. Kind of like when you go to a gym or a dance class or a martial arts class, you cover specific topics. So we'll go ahead and do that. Pretty much it'll be like the Let's Talk Stocks sessions, but we're going to go in depth into even more detail into core lessons and about the stocks that you want to go in detail. We'll look at, growing your account. We'll talk about a lot of different topics, but really in detail. And it'll probably be multiple video lessons like this on a weekly basis. So maybe, I'm not sure exactly right now how many lessons I can do on a weekly basis in that sense, because it does take up a lot of my time. But let's just say 2 lessons right there per week, that maybe you have a Monday lesson or a Tuesday lesson, and then you'll have this Thursday freebie lesson, and then you'll also have like a Saturday lesson or Saturday morning lesson that, we really would go in detail and cover specifics about, things like growing your trading account, setting up your account, like how to properly trade, as far as getting tax breaks on your account, such as the 1256 contract rule from the IRS when trading options. Some people don't know about that, but you can take a look at, the 1256 contract rule where you got the 60/40 tax break there. So just different things that really will help elevate your trading, and we can go into webinars and just discuss things live in detail. So that's probably going to happen after I release the options course. Again, something that I'm working and planning on because I want to get a little bit more connection going with you guys and really just hone in and really make it work for you, really specific to you and your needs. So those are just some of the plans. It's just right at this moment, I can't do it with the time that I have and the few things that I'm trying to wrap up. But we'll get there. We'll get there. It takes time, takes a lot of work. And I do have people that are helping me with some things, but there's just only so much time that I have available. So thanks again for joining me. Hope you enjoyed this lesson. Next week, more than likely, is the plan to release that book. Again, absolutely free. So keep your eyes peeled, open up the newsletter, and you'll get that book for free. And if you don't have a Kindle, you can wait the other extra week and we'll release it there on PDF within some time. And you'll be able to take a look at some of that little bit of a guidebook. So thanks again for joining me. Do what you love, contribute to others, but most importantly, live life abundantly. Thanks again, and I'll see you next time.